Welcome back, investors, to Fiscal Voyage. I'm Felix, and in this video we're doing a Dividend Aristocrat series for the next 20 plus days. I'm going to post a video every day with the Dividend Aristocrats. So this is part 2 of the series, and tomorrow I'm post part 3, so make sure to subscribe to the channel so you get notified for tomorrow's video. So in this video we're going to do an analysis on this particular company and determine if it's a buy, hold, or sell. Watch towards the end of the video and I give you my recommendation as well as a fair price versus its current price to see if the valuation makes sense. This particular company has been growing dividends for 26 consecutive years and it has a 5-year dividend growth rate of 20%. So it's very attractive based on that. Also, it has a very safe dividend yield. So continue watching and let's find out and do a deep dive analysis on this company. Okay, A.O. Smith Corp, ticker symbol AOS. The company is a manufacturer of both residential, commercial, water heaters and boilers, and the largest manufacturer and marketer of water heaters in North America. It also supplies water treatment products in the Asian market. If we look at the fundamentals, revenue grew very nicely at 8.1% annual growth rate from 2010 to 2019. Net income grew at an even better rate at 14.2% in that same time period. Currently, S&P Credit doesn't have a rating for it, but the balance sheet looks solid. Operating income came in at 21.3% for that 10-year time period, which is also great. And earnings grew at 20% rate over this 10-year period, which is outstanding. Considering that the earnings grew at a 20% rate, they had tremendous dividend growth. We'll talk about that in the next slide. However, the last 5 years, earnings has only grown 8.9%, so it's a much slower rate than the past 10 years. Revenue as well as net income grew at a slower rate. Revenue was at 4.2% for the 5 years, and net income at 7% for the past 5 years. If we look at the fundamentals for 2019, earnings were $2.22. Net margin came in at 12.4%, which is slightly lower, almost a percentage point from 2018, which had 13.9% margin. Return on equity is nice at 21.9%. Debt to cap is very low at 18%. The yield, however, has much to be desired at 2.27%. This is kind of where, for me, for example, I like to see companies at 3% yield or higher. So this is very low based on my criteria. However, the payout ratio is nice at 54%, so the dividend is very well covered. And this is based on 2020 expected earnings. And after 2021 and 2022, earnings are expected to be higher, so the dividend payout should be getting lower. The company has been growing dividends for 26 years, like I mentioned, and has a 5-year dividend growth rate of 24.6%, which is amazing. So basically, they were growing your dividend income at 24%, which beats inflation tremendously. Charter Rule, because of this, has a 26.9 score, which is the current yield plus the 5-year dividend growth rate. And the bright side here also, the 5-year dividend yield is only 1.28%. So that's, in the past 5 years, that's what the company's been averaging. And right now you could get it at a 2.27%. So it's much better, almost 100 basis point higher at current prices. The most recent dividend increase was 9.1% last year in October. So it's much, much lower than the 5-year growth rate of 24.6, but it's still a nice dividend increase nonetheless. If we look at the future outlook for this year, analysts expect earnings to come in at $1.75 a share, and 2021 picking back up at $2.20. Just for reference, last year they had earnings of $2.22. So earnings are going to be lower this year, of course, because of the coronavirus pandemic, but analysts are expecting them to be back to where they were in 2021. However, CFRA has projected earning growth of only 1% for the next 3 years, and my dividend yield return model is projecting an annual return current prices of only 8.8%. So this is right there in my criteria of 9% or higher. So 8.8% return on investment is okay. It's not great, but it's decent. You're making money. Currently, the company has a PE of 20.7, which is based on 2019 earnings. Forward PE of 25, which is based on 2020 earnings, which is again less than 2019. And their 5-year PE averages is up 25.8. So this right here gives me a good indication that the company is fairly valued based on price to earning ratio. So let's look at the fast graph. As you can see here, the black lines first off is the monthly closing price. The orange is a earning with a multiple of 15, and the blue line is a normal PE multiple of 23.5. As you can see, the company for the past 7 years or so tends to follow the earning multiple of 23.5. However, because of the lower earnings expectation of $1.75 for this year, that PE ratio is coming down, as you can see there. However, analysts are again expecting 2021 earnings to be level and match with 2019. So you can have a potential annual rate of return of 15%. However, I see the adjusted blended yield of only 4.8%, which is earnings with dividend yield. And I like to see this at 6, 7%, 8% or higher. So this is concerning for me. As you can see, the debt to cap ratio is only 18%, which is great. And as you see, from 2013 to 2019, the company was growing earnings quite well. But last year, they had a 15% decrease in earnings compared to 2018. But nonetheless, as you can see, the white line is the dividend payout. So the dividend is well covered based on earnings. So that's very positive there. If we look at the fair value price, CFRA has a fair price of $39, Morningstar at 42, Fast Graphs at 51, Yahoo at 40, and my dividend discount model analysis at 47. For my dividend discount model analysis, I didn't use 20% growth rate. I used a conservative 8 to 9% growth rate, and I came in with $47. So averaging out to 5, we get a fair price of $44.41. Currently, the company, as of this presentation, is going for $44.01. So that means the company is undervalued by 0.9%. So basically, it's right on fair value. I personally like to have undervaluation of 10% or higher, maybe even 15% or higher. But we're getting right at 1%. And that's why I have a hold recommendation for this company. So I have a hold recommendation on AOS Smith. That's because the dividend yield is quite low for me, particularly, and as well as the valuation. It's I like to see it under 17 PE or less. Right now, it has a pretty high PE, even based on 2021 earnings, which should be in line with 2019. However, I do love the dividend growth. It's been outstanding. Last year, like I mentioned, October had a 9% increase. The past 5-year average of 20%, which is great, amazing. But again, the valuation to me doesn't make sense. If you already own the shares of this company, continue holding it. Good for you for buying it maybe a year or two back, or even in sometime in April when it was very nice at $35 range. That was a great time to buy. But right now I have a hold recommendation. Also note that my recommendation, buy, hold, or sell, are not actual recommendation in the sense where you go actually and do that. For buys, for example, it basically means to spend time and research this company. I think you'll find it attractive, something that's worth the time for researching. A hold would be for a company to maybe add it to your watch list, something where if it reaches a particular price, it becomes attractive, and for you to further research. A sell will be something where I wouldn't recommend you to spend time researching this company or even looking into this company. So those are my 3 recommendations. It doesn't mean you actually go do those. It's just something to consider. So thanks again for watching. Make sure to subscribe to the channel for tomorrow's video, and like this video as well so that other people could be informed and and be able to watch this video as well. So thanks again for watching, and I'll see you to tomorrow's video.